All right, this is chapter six, the portfolio management of stocks. We're going to be discussing how mutual funds, how stocks operate inside of mutual funds. Sorry, got a little messed up there. So, what is an equity? Equity in the form of a common stock. It's an ownership in the stake of a company and the profits of that business. People can participate in the initial public offering of a stock, which is called an IPO. Investing in an IPO isn't really even that big of a deal. You're just getting into the company early. There are some statistics out there that show, early IPO investors actually lose money for a great deal of time. Subsequent sales of the stock constitute the secondary market. That's where we all make trades. That's where, 99% of the stock market is on the secondary market. You trading stocks, buying stocks with another party. How are equity owners paid? So the price can go up, the shares appreciate. They can also get paid by the periodic payment of dividends. A lot of people don't pay as much attention to stocks that pay dividends, but sometimes the dividends can be really attractive. There are some stocks in our portfolio that are paying north of 6% right now. So, why do you own stocks with dividends? Well, they tend to be more stable, less likely to kind of skyrocket like a growth stock. But, every asset really has a purpose in your portfolio. And that's one of the highlights here, really throughout the chapter is what are you building? There's a big difference between picking a stock and picking a portfolio of stocks. How do you want that portfolio to behave? Why hold stocks versus bonds? Although they have higher risk, stocks have high potential for returns. Over the long run, stocks do better. One reason people own bonds is to protect near-term spending against the long-term market. You don't want to be, if you're in all stocks and you need to spend off the portfolio, you need something stable in there because you don't want to be pulling from the stocks, aka selling them when the market is down. Stocks allow investors to benefit directly from the success of a company. Level of market cap. Market cap is the size of the firm, what the firm is hypothetically worth, and all it is the shares multiplied by the price. You don't judge how expensive a stock is by what it's trading at, or how big a company is by what it's trading at. You have to look at the market cap or the PE ratio, which we talk about down the bottom. They also, portfolio of stocks can also be compared to book value, assets versus liabilities, level of selected financial ratios. In some sense, the basics you'll look at are a P to E, price to cash flow, and price to book, as well as the dividend yield. That's the real basics in terms of some of the ratios. Let me focus on P to E really quick, hopefully give you guys a deeper understanding of it. So P is the price, what it's trading for. That's known. There's actually two types of PE ratios, backward looking and forward looking. So the earnings, and usually it's listed on the website when you're seeing or searching for that statistic. E is effectively, if it's last 12 months, that's known. That's what it's actually earned. So you have two known variables, price, which is the price it trades at today, and earnings divided by earnings, aka profits. But you can also see a PE for the next 12 months, what the average analyst expects it to be worth. And that's an estimate, right? So, sometimes PEs can be misleading. If a stock is a high growth stock, last PE is going to be higher than current or forward PE usually, right? Because earnings are expected to be growing. If a company is growing fast, you'll pay more for $1 of earnings today. Think about it. If you owned a business and profits were growing by 50%, you'd want to sell it for more money than a company that's growing at 25%. Category of anticipated movement of company earnings. So there can be cyclical companies, think cars, boats, businesses like that are cyclical, meaning when times are good, people buy them, and it's something we can hold off on when times get tough. Growth companies typically don't pay a dividend. They're reinvesting back into their business. You make money through the appreciation of shares. Value is typically higher dividend paying stocks. A value portfolio would probably have a dividend above 2 or 3%. And you'll still make money hypothetically on appreciation, but more of the value creation is by the cash flow it's paying out today. Some companies can go in between these areas, right? Um, Depending on the time horizon, I think Apple has been both value and growth. It just depends on how its profile changes over time. Some of you guys might remember it's March of 2024. Facebook or Meta recently just initiated a dividend. So are they becoming more of a value stock, right? Not yet, but it's getting there. Fundamental type of equity research. That's where you rate stocks based on the fundamental operations of the company. It's kind of the story of the stock. So you might look at it to predict future earnings, produce valuation measures, talk to the company's suppliers, distributors. We bought stock in a shoe company last year. And the thesis was simple. The shoe was popular and it was getting more popular. That generally is going to mean higher revenue and higher profits. The trick about fashion is, though, is you also have to know when to get out. Technical analysis, that's rating stocks based on past price movements, patterns. This is shown to have little efficacy, but there are some high efficacy charts and technical analysis that do have above average efficacy. We won't spend time on it here, but you might look at like a head and shoulders pattern, a death cross, a golden cross. All of these are versions of technical analysis. Also, quantitative research. We use quantitative research at my firm as like the first overlay. So we have a quantitative ranking system for our stocks that we use through a third-party company. Excuse me. And that kind of gives us an initial view of what is a buy and what is a sell. It has about 30 different inputs, so it does use some fundamental and technical analysis. It tries to find stocks that are mispriced. And our coverage area is the Russell 3000, and that's 3,000 stocks. So when you use a quantitative program like this, it says, well, the 3,000, only these 500 are technically buys. And that will give you a kind of much narrower universe to kind of hunt from. Buy-side analysts will work directly for the investment advisor that will buy securities for managed portfolios. They produce their own research, and shareholders have paid for the research through the management fee. Sell side work for Wall Street firms, produce research that is widely disseminated to numerous investment advisors, rarely issue sell recommendations on stock, possibly due to existing potential relationships. You have to look at all research with a grain of salt, because it doesn't mean, whoever's doing it doesn't mean they're going to be right. You see plenty of high profile people get it wrong. I recommend using Wall Street research in general, just to bounce off your own ideas or learn about a business. You have to you do have to do your own research, and oftentimes we do our own research and then marry it with what we see kind of on Wall Street. If we're missing something, if they bring up a subject that we weren't aware of, things of that nature. Analyze an individual company to determine the appropriate valuation, assess relative attractiveness of the stock to other stocks in the industry. For example, right now we've owned Airbnb for about a year. It's went up, it's moved to a sell in our work, and we're looking for a replacement name. And Marriott looks good, as well as Hilton looks good in our work. So now we're thinking about swapping out Airbnb for Hilton or Marriott. So we're going through the process of kind of doing a deeper dive on both of those companies just to see, what looks more attractive. We'll look at earnings growth, interest rates, investor sentiment. One characteristic that I'm looking at is, the high end of the market, the kind of, top 5 or 10% of wealth in America, they haven't really slowed down spending at all. So we might want to look for the hotels that have the higher end portfolio, and we're trying to figure out if that's Marriott or the Hilton. It looks initially like the Marriott, but we're still doing our research on that. This isn't a buy recommendation, by the way, guys. I recommend buying or selling particular stocks to our portfolio managers. So usually the process is there's a portfolio manager and they have analysts, and analysts kind of pitch the portfolio manager. The portfolio manager is just in charge of, um, what to buy and what to sell. You're also in charge of how things work together. So, for example, home builders right now look good on our work, but we're not going to own five, right? We're probably going to pick one or two max and then be done with it. They might all be buys, but you have to figure out how it works in conjunction with the rest of your portfolio. A lot of times you'll see people make the mistake of only owning tech stocks or only owning healthcare, and they're very correlated, meaning they move together. Fundamental equity analyst questions they ask: what is the company's historical performance, projected performance by segment, cash, and what they're going to use cash for, grow it and reinvest it into the company, pay it out in terms of dividends. Look at the supply and demand for the company's products and services, impact of any regulation potentially, and then track record and quality of management. Have they executed? Passive management objective is to match the performance of a particular index, the Russell 3000 for the all stocks or the S&P 500 for the largest 500 companies. And then success is often measured by a tracking error when you're talking about a passive strategy. This passive strategy, you don't want to beat the market. That should be in line with the market. May use full replication or sampling. What does that mean here? Well, you could actually create a portfolio that moves very similar to the S&P. Instead of buying 500 names, you could probably buy the top 250 and replicate the performance, because the smallest names in the portfolio have very little impact on performance, because remember, it's a market cap weighted index. Active management, the objective is to beat the market, and your market is the index, right? The S&P, the Russell 3000, by selecting stocks or overweighting and underweighting sectors. A portfolio manager is buying and selling the securities and may use top down or bottom up or both, right? Top down is looking at the sectors first and then the companies, and then the bottom up is looking at the companies and then potentially the sectors. And there sometimes is a team or an individual or a composite approach, like an organization. So the approaches to constructing all this can vary. Managers must make decisions within basic parameters of the fund. So inside the fund, you'll have an investment objective. And if you say you're a growth stock, you can't, it's against the rules to go and make it a value stock. So the name of the fund and the investment objectives have to be in line with what you're actually investing in. And how do they define it? 80%. So there's actually a pretty wide band. You can buy 20% of any portfolio outside of the mandate. Look at diversification and other regulatory requirements. Some funds are constrained in terms of what they can buy for a variety of rules. If you're a dividend fund, you have to buy a stock that pays a dividend. So that would be an internal constraint, and also a regulatory constraint if you list it in your investment objective. We already talked about this. What kind of indexes do you manage against? The S&P and the Russell 3000. This is an example of the Russell 1000 growth, which is the top 1,000 growth companies, as opposed to just the 500 biggest. Groupings are established by measurement organizations like the S&P or Lipper, and then relative performance rankings are calculated and published on a regular basis. Here's just an example here. S&P is large cap, mid cap, Russell or S&P mid cap. And then the small caps are the Russell 2000. On the left side, you have the value quadrant. And on the right side, you have the growth quadrant. This is very popular benchmark style classification if you go visit Morningstar.com. And this is just showing the weight in the fund and the weight in the index. So this relates to portfolio attribution, which we'll cover soon too. But, basically the fund has a 3.9% weight in GE. And the index has a 3.6 weight. So, it looks like a big position at 4%, but they're only 0.3% overweight compared to the benchmark. And while you might say, oh, they have a 2.5% weight in Microsoft, well, the index has 3.5% weight. So they're actually underweight and showing a negative posture on Microsoft with that weight. Here's an example of an attribution report. This is really based on the homework that we had in that little project. So right here, all the way to the right, it's showing a bunch of sectors or S&P groupings. I'll show you a better one that's a little bit more clean in 1 second. But the right column is all the alpha they got from the portfolio. Actually, I'm going to show you a better one. This is like one I did for myself. So this is an attribution report that we did for our firm. And basically what it's saying is here is we got 1.7% in alpha from the weight of the sectors. So these are the total, and we had a total outperformance of 1.3%. Where did most of that come from? Our weight in technology. The benchmark had a 24% weight. We had a 26.5% weight. So that overweight to technology added 0.6 to performance. You know, what else, what took away? There's not much took away in this category. We had a small overweight in real estate, and that detracted 0.03%. But you can see here in real estate, the stocks we selected in real estate added 0.3% in value. Overall, our stock selection took away 0.41%. The biggest detractor being the consumer sector. Actually, no, the biggest one being healthcare at negative 1.75. That was a huge detractor. All of our negative alpha came from really that healthcare sector, which, you know, was specifically biotechs during this period of time. Hopefully this is helpful in, you know, getting a better understanding of the attribution report. So, you know, we would say that, you know, we had a negative effect from healthcare stock selection, and we had a positive benefit from an overweight in information technology. In utilities, we had 0.17% alpha because of an underweight to utilities. We had a 2%, average was 0.265. Same thing with energy, or similar with energy, we added 15 basis points or 0.15% in alpha from an underweight to energy. Summary of the investment process: identify a security pool that is appropriate for portfolio objective and benchmark. Choose the individual securities with expected returns that you think will be above average. Design the portfolio by sector or individual security weightings. We do both. Conduct performance attribution, which we just reviewed, to determine what did not add value, and monitor and adjust that portfolio over time. You want to consider liquidity. So what kind of stocks do you want to invest in, and what market? Do you want to focus on the US? Cash flows. You have to consider when you're running a fund that people are going to need money. So how do you construct that portfolio? You can't be buying too much stuff that's illiquid. All right, guys, that's the end of this chapter. Thanks.